Good morning, and thank you for joining us to discuss UGE International's fiscal year-end 2021 financial results for the period ending December 31st, 2021. On the call today, we have UGE CEO Nick Blitterswyk and UGE CFO Stephanie Bird. During the call, all participants are in a listen-only mode. Following the presentation, we will conduct a question and answer session. We've collected a number of investor questions via email, but you can also submit your questions through the Q&A tab in the web portal at any time, and management will answer them following their prepared remarks. Before management discusses the results, I'd like to remind everyone that certain statements in this call may be forward-looking in nature. These include statements involving known and unknown risks, uncertainties, and other factors that could cause actual results to differ materially from those expressed or implied in our forward-looking statements. For caveats about forward-looking statements and risk factors, please see our MD&A for the year ended December 31st, 2021, which can be found on our company web profile at sedar.com and on the company's website. With that, I'll pass the call over to UGE CFO Stephanie Bird. Stephanie?
Good morning and welcome to everyone on the call. I'm Stephanie Bird, CFO of UGE International, and I'm joined today by our CEO, Nick Blitterswyk. For today's webinar covering our audited 2021 results, Nick will begin by summarizing our key business highlights for the quarter. Next, I will run through our 2021 financial results. From there, Nick will provide some concluding remarks with a look towards the future before we take questions and then wrap up the webinar. As a reminder, you can submit a question through the portal on the left-hand side of your screen, and we will run through them after our prepared remarks. As always, our goal is to be mindful of your time and keep this webinar concise and to the point. We will be speaking relatively high level and focusing on the areas that we feel are most relevant to understanding our business and financial results. Our website address is listed here as well, where you can download our full financials. We also want to remind our listeners that we report in US dollars, so the results of this webinar are represented in US dollars unless we say otherwise. So with that, let's start talking about our key business results for the fourth quarter. Over to you, Nick.
Stephanie. As Stephanie mentioned, I'll start off by talking about our project development work and other business updates. On this slide, you see the overall project development table as of December 31st, 2021, which you can find in our MD&A. Moving to the next slide, when we began 2021, we set out to scale the organization to capture a greater share of this high-growth market. We strongly believe that this decade is pivotal in the world's shift to renewable energy and believe it is an unprecedented opportunity for UGE and our shareholders to benefit from the transition. With that background, 2021 was an incredibly exciting year for UGE. As we scaled the organization, we saw our overall pipeline grow to levels well beyond our initial goals. This slide here represents all the projects we're working on, from initial proposals through to operating assets. In sum, our total pipeline grew from approximately 200 megawatts on December 31st of 2020 to almost 1.2 gigawatts on December 31st of 2021. This six-fold growth positions us for continued success in the coming quarters and years as projects mature through the stages. What we'll do over the next few slides is strip out stages to narrow our view on certain aspects of our pipeline. On this slide, we have removed all of our earlier stage pipeline projects and zoom in on all projects, stages 3.0 and above. This represents all projects we have under contract, from the earliest stages of development, denoted by stage 3.0, up to operating projects in stage 6. A few notes on this view. First, a project enters stage 3.0 once we have a contract with the client, or what we refer to in the industry as site control. You'll notice that stage 3.0 was only added for Q3 of this past year. Previously, many of these projects would have been added to stage 3.1, which contributes to our backlog measure. But with greater scale, we thought it was beneficial to both add another stage prior to 3.1 and to be more conservative with when projects are moved into our traditional backlog measure. We refer to this grouping from stage 3.0 to stage 5 as projects in development, and the volume of projects across these stages also grew approximately sixfold in 2021. Zooming in further, on this slide we see stages 3.1 and above, which is mostly representative of what we refer to as project backlog. Backlog was just under 60 megawatts at the beginning of last year, but we set a goal to double that to 120 megawatts throughout the year. We ended up smashing that goal by reaching 158 megawatts by year end. As a reminder, we saw that decrease in Q1 due to resizing of projects in Maine, but it has been growing again in April, currently sitting at 150 megawatts. As mentioned on prior calls, the time spent in each of these stages is not equal, with interconnection approval usually being the longest lead item, but also the item needed to move projects from stage 3.1 to stage 3.2. To illustrate, we currently have several projects in stage 3.1, which we expect to move into stage 4 and 5 this year, as they await final interconnection approval. Zooming in one last time, here we see our operational projects as well as projects that are within stages 4 and 5, meaning they have reached notice to proceed and are in construction. Although we still have much work to do, you can clearly see here our operating portfolio starting to scale, which will quicken throughout the rest of the year. Approximately 1.5 megawatts of projects currently in construction are expected to be completed within Q2, which will double our operating portfolio. We expect project deployments to ramp considerably in 2022 as our pipeline matures. Just to summarize, we had really significant growth in 2021. This included our total pipeline and projects in development, each scaling approximately 6 times, and our operating portfolio almost doubling. So far in 2022, we have continued to make good progress. If you look at 2020 and 2021, the first quarter tends to be our slowest quarter for backlog growth, which was true this year as well, with it dropping to 144 megawatts. That said, we've been making good progress so far in April, with backlog currently sitting at 150 megawatts and expected to continue to grow throughout Q2. Within this year's growth has been our first standalone battery storage projects in Massachusetts as part of the expansion into that state that we announced in November. We are also excited to soon start building our first self-financed community solar projects in Maine. We also announced we had signed an LOI to acquire 2 projects pre-NTP. As we scale our operating portfolio, acquiring such projects is an attractive additional lever for us to grow. This is all on the back of continued growth in our development pipeline, which is well in excess of 1 gigawatt and gives us a lot of confidence in our substantial growth continuing this year. On my last slide, before turning things over to Stephanie, we wanted to highlight a few other important updates from 2021. First, community solar is still relatively new. It was only a few years ago that there were only a handful of states that allowed community solar. In 2021, there were 22 states that passed some form of enabling legislation. With 75% of community solar projects installed so far coming from just 4 states, we believe the floodgates are opening for growth in this sector. The Department of Energy has set a goal for approximately 8x growth for the sector over the next 4 years, highlighting the potential. This growth would be the equivalent of the entire history of the US residential sector being built in just 4 years. As community solar expands, we have started to attract some significant names as off-takers of our energy as well. In 2021, we announced a partnership with T-Mobile to provide clean energy to offset their energy consumption in New York City. We have recently expanded the T-Mobile relationship to Massachusetts as well. We also announced a partnership with Bloomberg last summer. For all the growth in the industry, it's not without its bottlenecks, so I want to touch on supply chain more generally, trade disputes, and interconnection. On supply chain, while it seems that all industries have been impacted by tighter supply chains of late, as a general subject, this hasn't been too significant of a bottleneck for us. Our project deployment timeframes are measured in many months, meaning that we can generally still get the equipment that we need when we order ahead of time. Yes, prices are somewhat elevated versus what they would otherwise be, but not enough to materially impact our project returns. So while we wait for supply chains to normalize, we are making do in the current environment. Longer term, we fully expect a return to the long-term pricing declines that our industry has seen, and historical increases in manufacturing capacity this year and last point to that eventual reality. What deserves specific mention, however, is a current situation regarding a Department of Commerce investigation into solar panels imported into the US from most countries in Southeast Asia. The high-level background is that the vast majority of solar panels installed in the US come from Southeast Asia, which itself is a result of tariffs against manufacturers within China. In essence, supply chains evolved several years ago so that manufacturing in Southeast Asia fed the US market. What happened in March is that a very small company called Oxen Solar, which manufactures a microscopic volume of solar panels in California, filed a petition to the Department of Commerce asking that they investigate whether these manufacturers in Southeast Asia were circumventing those tariffs on imports from China. One study estimates that the petition impacts 84% of all solar panels used in the US, so it is a very far-reaching case. The industry, led by SEIA, is staunchly opposed to this petition, but nevertheless, the Department of Commerce is currently investigating. It should be noted that there was a somewhat similar situation last year, which was ultimately thrown out by the Department of Commerce. But in the short term, until this is resolved, imports to the US have ground almost to a halt. Broadly speaking, the industry expects that this should be resolved by some point in the summer. The industry is lobbying hard for a quick resolution, and until one is found, you can expect to hear a lot from the industry about projects being delayed and the harm it is doing to the industry as a whole. As it relates to UG specifically then, any potential delays are expected to be shorter term in nature, since we are expecting resolution in the coming months, but it will depend on how long this lasts. There is still some supply available. For example, one of our main suppliers has manufacturing capacity in an unaffected country, but this is providing a bigger speed bump in the coming months than the supply chain conversation overall. We should mention that generally we have seen the Biden administration making favorable moves to support the industry. It was in our last webinar, when we released our Q3s, that we talked about Department of Commerce rejecting last year's petition on imports from Southeast Asian countries, as well as exempting bifacial panels from Section 201 import tariffs. We have confidence that we will see calmer waters in future as it relates to trade. Interconnection has also been talked about in our industry a lot of late. In very general terms, the way I would describe this is that our industry is growing very rapidly, and utilities are having trouble keeping up as new projects are added to the grid. Effects can vary quite substantially based on where one is operating. For example, I would broadly describe New York, New Jersey, and Massachusetts as more mature markets where timeframes are more predictable. Of course, we've suffered delays in Maine as we've waited for approvals. This is more indicative of a newer market that has had trouble keeping up with the growth in that state. Big picture, it is on us to plan and forecast accordingly, and to build a diversified portfolio across many states, just as we are doing. Industry-wide, I expect that this will be a continued talking point, though, as our industry scales and as the grid transitions to renewable energy. Lastly, on the project funding environment, we continue to see a robust market for debt and tax equity and continue to expect to compress our rates on project debt as our portfolio scales. We are currently in the market for our upcoming main installations, and will report back in due course as those projects reach notice to proceed over the next few months. And with that, I will now turn it over to Stephanie to summarize our 2021 financial results, and then I'll return for some concluding remarks before taking your questions.
Thank you, Nick, and thank you for joining us today. I'm going to review a few key items from our fiscal year results, but before that, I'd like to extend our thanks to our new auditors, KPMG, for the smooth process to get our results released this week. Thank you very much. Looking at slide 11, in 2021, UGE's energy generating assets increased as a result of installed capacity, moving from 802 kilowatts to 1,420 kilowatts, so production increased as a result. The 2021 generation includes less than a full year for the 618 kilowatts added, meaning that 2022, with a full year of generation on that facility as well, will be even greater. This increased capacity translated into $189,000 of revenue for the fiscal year 2021, which will likewise grow into a higher recurring revenue when there is a full year of operations in 2022. Revenue from client-financed EPC agreements was $2.2 million, an increase of 90% from $1.2 million in 2020. This increase was largely due to COVID-delayed projects from 2020 being substantially moved forward in 2021. Engineering services revenue was $247,000, an increase of 20% from $205,000 in 2020, and a result of increased and more methodical focus on engagement acquisition. As this part of the business is growing, it was time to split it from EPC, which is where it had been in prior reporting periods. As mentioned in our Q1 business highlights announcement earlier this month, in the first quarter of this year, our engineering business secured almost $600,000 worth of new engagements, meaning we're expecting solid growth from that business this year. Overall gross margin for fiscal 2021 was 32% compared to 36% in fiscal 2020. You can see on this page that the margins vary between our service lines. Generation margin was strong at 83%, which is indicative of margins for this line of business moving forward. It should be noted that 2020 was impacted by initial setup costs for our first projects, with less than a full year of generation impacting the gross profit. EPC margins were 27% in 2021 versus 34% in 2020 as a result of the impact of COVID-related delays, as well as the mix of work between the years. Generally, a 27% gross profit margin for this type of work is considered above expectations. Engineering services margins were 39% in 2021 versus 48% in 2020 as a result of the mix of work engaged. Operating expenses for fiscal 2021 were $5.4 million, a 51% increase versus fiscal 2020. The increase was largely due to the increased employee and contractor headcount from 36 at the end of 2020 to 51 at the end of 2021, which impacted both salaries and benefits, as well as general office expenses. I'll also point out that approximately $600,000 of these operating expenses were related to non-cash, share-based compensation expenses. Adjusted EBITDA during fiscal 2021 decreased 66% to almost $4 million loss compared to $2.4 million loss in fiscal 2020. A large portion of the decrease is attributable to the increased office and headcount costs as we scale to both build and maintain our solar facilities, with the remaining increase attributable to professional fees and non-cash share-based compensation expenses. Net loss for the fiscal year was $4.2 million, a 320% increase versus fiscal 2020, reflecting our position in time where we are heavily investing in our future portfolio of operating assets. In 2020, there was an offset to these expenses in one-time gains associated with the wind down and exit of the Canadian EPC business that was not available in 2021. The results from the fourth quarter are also shown in this slide, with variances largely linked to the commentary already discussed. As a reminder, we are in the process of transitioning from a one-time revenue model to a recurring revenue model, and losses are expected until the company's self-finance portfolio reaches a larger scale of project deployments and operational projects. Even so, it's important to note that developing and building projects can create positive cash flows through the development cycle by the retention of a developer fee, which will become more noticeable as our deployments continue to scale. Moving to the next slide, let's look at our financial position. We exited the year with $1.4 million of cash, $250,000 of current operating and project debt, and a $329,000 working capital deficit. With respect to our cash balance, we are earning cash from a small number of client-financed EPC projects, as well as our core continuing cash flow sources of developer fees, engineering services, and operating solar facilities. Our core continuing cash flows are not yet at the scale to have positive net cash results. So as we continue to scale up our development efforts and the backlog matures to yield more projects in deployment, cash inflows from the developer fees in particular will provide us with improved stability in our cash balance. Our balance sheet has been growing as projects progress through our backlog. Leases add to both our long-term assets and long-term liabilities, and the quarter-over-quarter growth for both the right-of-use assets and the offsetting lease liabilities reflects the impact of long-term leases signed in the year. This is also evident in the year-over-year, which is shown here. With the settlement of a lawsuit where we were owed for a project from 2019, our trade and other payables, as well as the offsetting accrued receivables, have been relieved. The decreases in these accounts from this activity have been somewhat offset by activity from growth. Our overall operating debt has remained essentially the same level between December 31st, 2020 and 2021. However, the composition of it has changed from a variety of loans to one convertible debt, one loan in the Philippines, and several government-sponsored COVID relief loans. Post-year end, we completed a 2.9 million Canadian green bond as well. Project debt, as expected, has increased from 1.9 million to 3.2 million as a result of the growth of our operating assets and facilities under construction. That concludes my prepared remarks, and I will turn it back now to Nick.
Great, thanks, Stephanie. As you can see, we are making solid progress towards our goals. In 2021, we set out to grow our origination and development efforts to capture a greater share of this fast-growing market and to achieve greater scale as an organization. With our pipeline and projects in development, each growing approximately sixfold in 2021, we are well on our way to achieving our longer-term goals. With this growth, we are in a great position to exceed our 2024 goal of having 100 megawatts of operating assets as well. Of course, we really see 100 megawatts of operating assets as the tip of the iceberg for this business. Our secondary 2024 goal was to grow our team so that it could add 100 megawatts of backlog per year by 2024. Based on our growth in 2021, we expect to reach that figure this year of adding 100 megawatts of backlog per year, 2 full years ahead of schedule. And on the slide too, you can see, this is taken from our investor presentation, but an estimate of what the 100 megawatts will provide in terms of both net retained value, but then also EBITDA on the portfolio levels as well. And I'll also touch on the fact that as of this morning, we have 349 megawatts of projects in development on top of the gigawatt pipeline. So we feel like we're well on our way towards these goals. With that, we'll wrap up the prepared remarks by pointing you to where you can find more information. As mentioned earlier, our website is regularly updated. It contains all of our financial filings and other updates. You can also find our financial filings on SEDAR. You can also visit Sophic Capital's website for additional information and follow us on Twitter to get links to announcements and other media. Thanks again for tuning in today. Marcel, back to you.
Thank you, Nick. We've collected the questions investors have submitted since issuing the financial results this morning, and we've also collected the questions submitted through the webinar's Q&A tab. We'd like to thank participants for your questions. Moving to our first question from Samir Joshi at H.C. Wainwright. Backlog was 150 megawatts as of December 2021 and currently stands at around 149 megawatts. Was this all attributed to the Maine projects?
The decline was almost all attributable to the Maine projects, and just as a reminder, this was in our quarterly update at the beginning of April. But in Q1 in Maine, we had filed some good cause exemption requests to keep 6 of our projects at an old 5 megawatt AC cap per project, and as of now, that request has been denied. So we revised our backlog number for those 6 projects. So that was the primary reason for the decline. And as of March 31st, it was 144 megawatts of backlog. Since then, it is 149.8 as of this morning. So we're seeing that grow again, and that growth is in part based on the portfolio in Massachusetts that we've been talking about, maturing into backlog and going through the stages there. But there's good, robust activity in other markets as well.
What's the status of activity in New Jersey? There is going to be a permanent community solar program planned by the New Jersey Board of Public Utilities. Do you have an update on that?
Yeah, that's right. At a high level, the announcement earlier this year was that instead of, they were going to have a third pilot year, and instead of that, they are moving to a full permanent community solar program. There is still aspects of that are being ironed out. I know right now, late April, like I think it is fairly near term. I believe within Q2 is when that's supposed to be finalized. But in the meantime, that's not stopping us from starting to develop more projects in New Jersey ahead of when the final details of that program are finalized. So we're definitely excited for the future of the New Jersey Community Solar Program.
What's the status of the 3 projects slated to go operational in January 2021 in New York?
Yeah, so I know I mentioned in the prepared remarks that we're expecting all 3 of those to become operational by the end of Q2. So all 3 of those have different forecasted commercial operation dates, but those are all quite near term, and we're excited about those for several reasons. One aspect is it more than doubles our operating portfolio. It's also the first 2 of those sites are, some of the offtake is Bloomberg and some of it's T-Mobile, and the third one is primarily T-Mobile. So those have been relationships that we're excited to keep building as well.
Are you still planning to start development of 36 megawatts of projects in 2022 and 100 megawatts in 2023?
So there was a word "still" in there, so I'm not sure what the reference is from. I think that in terms of development, I mean, I'd say that right now we're broadly speaking developing, I think, 349 megawatts of projects in various stages right now. So yeah.
Okay. Next question comes from Jeff Powell, private investor. Current project value is about $1.75 per watt. How robust is the market for pre-developed assets? Can you give some color on how realistic it is to use this as valuation?
There's a couple of things I want to mention on that. So number one, in terms of the value of projects. So it was mentioned $1.75 per watt. I think it's a good opportunity to mention, like, as these projects are being financed, built, and becoming operational, it is the standard practice to get independent third-party valuations on those projects, and that's partly done for tax equity reasons, to put a value on those projects, because tax equity is largely based on the value of those projects. And so I mentioned that because as we've been getting valuations on these projects, we've been seeing numbers significantly higher than $1.75, certainly starting with a 2, and well into the 2s. So I'll just mention that in terms of like the value of these projects. I think the couple other things that I'll mention, I think that, ultimately we are a project company and a project development company. So the value that UGE provides our shareholders is the value of the project that we're bringing to fruition. So, from my perspective, certainly this is the way to be thinking about the value of UGE is what are the value of these projects that we're bringing to fruition. And in terms of how robust is that market, I would say anecdotally on a weekly basis, just myself gets contacted, let's say on average 1 or 2 times a week by groups looking to buy projects from us. And of course, within the organization, our head of the US development team and our chief revenue officer and so on are all getting contacted as well. So it is a very robust market out there for the projects that we're developing. Feel like I'm maybe going on and on about this point, but like the most valuable thing in our industry and in the tradition of renewable energy is developing good projects. And so this portfolio, is just using those numbers earlier, 349 megawatts. If I use $2 a watt, which I think is probably still conservative, that's give or take a $700 million USD portfolio on top of the pipeline before that. So certainly a high multiple of what we trade at today, and so we're looking forward to realizing the value of those projects as we complete the development of them.
Are states like Pennsylvania experiencing similar challenges that have resulted developers getting cut back, like in Maine?
Not specifically like Maine. Each market can be a little bit different, and I know that we mentioned in the prepared remarks that like a more mature market kind of has, generally speaking, I would say, kind of its act together, and then a brand new market is for various reasons kind of struggling to keep up or what have you. Pennsylvania is part of PJM territory, and so there has been some notes about PJM looking to slow down interconnection approvals and so on. Pennsylvania is not directly like Maine right now. Maine, there's a large number of projects that are like ready to build, ready to connect. Pennsylvania is a bit of an early stage market, and I think you're starting to, with the volume of interconnection approvals coming in, you're starting to get some of the conversations about how best to approve these. Now, I will say there's utility scale projects, there's our mid-scale, mostly community solar projects, there's residential projects. Also, like depending on the size of projects, these things can vary as well, based both on timelines and so on. Big picture, it's up to us to forecast accordingly about how long it's going to take for these projects to make it through, etc. I think that we were still quite optimistic about Pennsylvania. I think our first NTPs that we're forecasting in Pennsylvania is 2024 anyway, right? So it kind of speaks to, we know that these things are going to take some time. I'd be remiss not to say, in Maine, we had a situation where they decreased the maximum size of a community solar project from 5 megawatts to 2 megawatts. But 2 things on that. Number one is Maryland is just in the process of increasing from 2 megawatts to 5 megawatts. So it does cut both ways. But then number 2 is, if you're doing, let's just say if you're doing 1 5 megawatt project, or if you're doing, 2 megawatt projects and a 1 megawatt project, if you have the volume, there's still great opportunity out there. So it's not that we've soured on Maine in any way. It's just a matter of working through the growth in this industry and making sure that we capture our fair share. So if you back up and take a look at the overall picture here for a moment, solar is about 45% of all new energy being built in the US right now, projected to get to 80% by the end of this decade. There's a ton of things happening, and it's up to us to navigate through that, better than anyone else. So,
Your recent green bond offering, how much operational time does this give you? Is there additional demand for these bonds? And is UGE going to further utilize this?
So I know that Stephanie mentioned in the prepared remarks that our overhead last year was 5.4 to 5.5 million, of which 600 to 700,000 was non-cash share-based compensation. So if you look at that, you come out to 4.8 or so. So when we raised, that's USD, we raised 3 million or just under 2.9 million of green bonds on April 8th. And very pleased with how that went, and feel like we put together a really good program, and closed that within 10 business days, or I guess actually 5 business days when we announced it. So we're quite happy with that. We've had a number of good conversations since then, and we do feel like there's appetite out there to further scale up that initiative. And so from that perspective, it is something that we plan to do more of down the road. And I should say too that we did our first green bond offering in 2018, and so we feel like we had some good track record with certain investors who took part in that. We're a bit of a pioneer in terms of this market, and so also happy to be scaling that up further. And of course, like from a dilution perspective, especially when we trade at a pretty big discount to what our analysts suggest the future price of this company should be, and so on. We feel like this is a good option from a dilution perspective. But then also lastly is that from we are a projects company, like I mentioned, and even though we did talk about the assets on our balance sheet increasing by more than 3x in 2021, but there's also a non-accounting term asset. There is value to the portfolio that we're building, and also provides us with something to leverage as we fund our growth going forward.
When can we expect more details about the 81 site LOI that you signed with the real estate company a few months ago?
Really good question. I'm glad someone asked that. So that we are making good progress on that. We are expecting our first of those projects to move to stage 3.1 by the end of this quarter. So it did take a little bit of time to kind of get that program going with that REIT, but we're quite happy with the progress we've been making of late. So by the end of Q2, we're expecting those first projects to move into backlog. And again, it's a good point to mention that through the course of 2022 and beyond, we feel like the window is open for other types of larger scale relationships like that as well.
Next question comes from Sean Keeney at 8 Capital. Can you expand upon the large $6 million client finance EPC project you added during Q4? When do you expect to convert that to revenue, and what is a reasonable profit margin to expect?
So I believe what's being mentioned there, actually, so this relates to, there's 3 New Jersey projects that are part of, those are year 2 of the pilot program for community solar projects in New Jersey. And the way we describe that is we're co-developing those projects with a real estate owner. In those cases, the real estate owner is funding the projects themselves. So we are getting compensated for developing, helping develop those projects, and for the EPC in essence of building those projects. So in terms of margins, I know Stephanie mentioned in the prepared remarks that our EPC margin was 27% in 2021, and that was probably a few points higher than typically what EPC margins should be. So if you think about sort of lower to mid 20s as a more representative number for that type of work.
And we had some follow-up questions from Samir Joshi at H.C. Wainwright. What's the average size of projects to begin development in 2022? Is it still approximately 1.2 megawatts?
I'll say anecdotally, I would expect it to be higher than that. I don't have the specific number, but I will point to, on our website, we do post a supplemental disclosure file, which does list our projects from stage 3.1 and above. And so just so I don't mess up the math, I would suggest looking there. I would say that I would expect it to be a bit higher than 1.2 megawatts. And I would say, generally speaking, we've seen that number increase over the last few years. Yeah.
You mentioned that the first self-financed community solar projects in Maine are about to start. Can you give us a more detailed update when you expect those to come online, how they're progressing?
Yeah. So in our I'm pretty sure it was in our Q1 milestones press release from earlier this month that we talked about 10.7 megawatts of projects in Maine that we were prepping for notice to proceed. So across that's 5 projects. Across those 5 projects, they each have their own independent dates to start. One in particular is very, very close to hitting notice to proceed. When I say very, very close, certainly weeks. Certainly weeks, I'll say. But across those 5 projects, they're in various stages of just waiting for their final interconnection approvals. In one of them fully approved already. 2 of them mostly approved. There's, I think, one aspect left that we're just waiting on, which is we've already got our approval, we already have our cost allocation, and it's just a matter of timing. And then the last 2, we're still waiting on some approvals that I believe are supposed to come in. I believe it's June 15th, give or take. So in all those cases, it's certainly looking to be notice to proceed with those projects in the not too distant future here, but a little hard to predict. So in terms of COD on those projects, at commercial operation, that first one that's very close to starting construction, that's one that we expect to reach commercial operation just before the end of the year. And then the other 4 probably bleed early into next year at this point in time, given what we've seen in interconnection in Maine of late. But we're excited to get those going and be able to finalize the commercial operation date as soon as we do.
Can you also give us a general update on activities in the Midwest, California, and Arizona? Do you need additional resources for these regions?
Good question. I think let's see. Broadly speaking, there's really interesting activity all across the country right now. And from an organizational standpoint, we've really been growing over the last 2 years from quite a regional player to towards our goal to be a national player in this mid-scale / community solar space. We'll be pragmatic. We'll make sure that we're picking our targets accordingly. But we did mention again in early April that we had added a second person in LA. So we have 2 people in California now. We did sign the LOI to acquire those 2 rooftop PPA assets in Arizona. There is a community solar program in New Mexico. So like the Southwest has some interesting activity. And then also I will mention actually that the 81 site LOI that we talked about earlier, some of the initial sites from that we're expecting to move into backlog are in the Midwest. And there's a lot of interesting things happening in the Midwest right now as well. So, on the topic of resources, Stephanie did mention we went from 36 to 51 people in 2021. We're expecting much more measured growth this year, but with our increasing size and scale and capabilities, we certainly see the ability to be developing projects in some more areas as well. So we have I'll say we have added someone in the Midwest fairly recently and so on. So it's like developing projects, not a situation where we need 10 people on the ground in Wisconsin if we want to develop projects in Wisconsin. It's much more a matter of first on a development perspective. There's 1, maybe 2 people that are leading the development to this. And as those projects reach the construction stage, then it's a matter of the project management and so on. But I guess what I'm trying to say is like we feel like there's great opportunity that's within our ability to continue to expand throughout 22 and beyond.
Yeah, there's a related question to that. What type of margins can we expect on the Arizona projects?
So from a margin perspective, what I will say, so those are projects we're financing, right? So from that perspective, it's going to be recurring revenue and recognized over time. I know Stephanie mentioned in the prepared remarks that 2021 had an 83% gross margin on our recurring revenue. Stephanie, correct me if I'm wrong on this. I don't think either of us are in a position on this call to say what the gross margins expected on those projects in Arizona, although I know that we are quite happy with the return we're expecting overall.
We're still in the diligence stages for those. So that's going to be solidifying over time as we become more familiar with them. But when we did the initial pass on them, they were certainly going to meet our hurdles.
Next questions come from Alistair D'Souza. When do you expect to hit break-even cash flow?
What I'll say to that is, I know that in the presentation we talked about 100 megawatts 2024 goal, which of course is the calendar year after next at this point in time. And we talked about portfolio EBITDA on that of 15 to 18 million. Our overhead, right now is 5 to 6 million. So we're expecting to be quite substantially profitable and cash flow positive as we get to those levels. We expect, of course, to cross over that threshold before then. We haven't put a specific forecast on when that would be exactly, but obviously if you look at 2022, 2023, and 2024, we're looking both through operational projects, but even more so the developer fees to be crossing that threshold in, call it the not too distant future here. And very excited for seeing this portfolio mature and get to that point.
And when do you expect the 10 megawatts of projects nearing NTP to become operational?
Yeah, I think I tried to answer that question earlier, and I think just to reiterate some of the points, the first one is very close to NTP, and when it hits NTP, then it's like, okay, here's the construction schedule, let's go. And so that one we're still expecting to have operational by the end of the year. The other four are, is it going to be December? Is it going to be Q1? Like it's sort of just hanging in the balance right there as those final dates are set. So I will say too, there's those main assets. There's other projects that we're expecting to start building on this year as well. So, certainly looking forward to hitting NTPs and other projects and sharing updates on those schedules too.
Next question from Michael Fassel. What percentage of projects in development are under federal regulatory versus state regulatory?
I would say that everything is under state regulatory from that perspective. There's no project we're developing that's crossed state lines or anything like that. There is the federal investment tax credit, which forms part of the capital stack in these projects. But for mid-scale projects, the regulations, if you will, that we're going through, it's getting interconnection approval with the local utility, it's getting permits from the local town, it's those types of things.
I'm just looking at the questions here. We have one from Lakshya Chow. How many megawatts will be operational by the end of 2022?
Yeah, so how many megawatts will be operational by the end of 2022? So I'll sort of like kind of lead the question towards so we have the 1 point, it's I think rounds to 1.6 actually that's in construction right now. We have the 1.4 to 1.5 already operational. So of course there's 3. There's the first Maine asset, which is coming up shortly. There's some other projects outside of Maine that we're hoping to get operational by the end of this year. So we haven't put out specific guidance, and so I don't want to change that on this call necessarily. But just the construction ones right now will double the operating portfolio. We had that chart earlier in this presentation with sort of like the staircase towards more material numbers. So we'll continue to update that as the quarters go on here. We'll of course be back in providing the next webinar in I think just 4 weeks as we have our Q1s. So so we haven't put out specific short-term guidance right now. We've just been putting out the 2024 guidance. But and I'll say again, we do put out that supplemental disclosure file, which does provide pretty good granularity on a project-by-project basis, our current expectations about size and timing of each of those projects.
Okay, there are no further questions, so I'll pass the call back to management for closing remarks.
Great, yeah, thank you so much, Marcel, and thank you everyone for the questions. I think, I believe I'm not mistaken, this may have been our most widely attended webinar yet. We appreciate everyone's interest. Also, I'll just say, like Stephanie said earlier, I really appreciate the work done by KPMG, our auditors, and feel like that was a good relationship and great team effort by Stephanie and Jacqueline and the rest of the finance team at UG as well. So, thanks again. We're excited for everything that's happening here. We'll continue to push forward and look forward to the next update in just a few weeks.
Which includes UGE International's 2021 fiscal year-end conference call. Thank you for attending.